price makes a new high, but momentum doesn't. That single observation, called divergence, is one of the earliest warnings that a trend is running out of fuel. Today, we'll dissect divergence using two of the cleanest tools for spotting it: the relative strength index and the moving average convergence divergence. We're going beyond definitions into entries, exits, confluence, and the traps that catch most traders. Trends are sustained by the rate of change of price, not just price itself. When each new swing high requires less momentum to print, buyers are exhausting. Divergence makes that exhaustion visible by comparing the slope of price against the slope of an oscillator. If the two disagree at meaningful swing points, the dominant side is quietly losing control. RSI is a normalized ratio of average gains to average losses, usually over 14 periods, mapped onto a 0 to 100 scale. Above 70 is conventionally overbought, below 30 oversold. For divergence work, the absolute level matters less than the shape of RSI peaks and troughs relative to price peaks and troughs. MACD subtracts a 26-period exponential moving average from a 12-period one, then plots a 9-period signal line on top. The histogram is the difference between them. Because MACD is unbounded, it reflects the absolute strength of momentum, which makes histogram peaks and troughs especially useful reference points for divergence. Regular bullish divergence forms when price prints a lower low, but RSI or the MACD histogram prints a higher low. Sellers pushed price further down, yet with less force. This is a reversal signal, typically appearing near the end of a downtrend. The cleanest setups occur when RSI is also below 30 on the first low. The mirror image. Price grinds out a higher high, but the oscillator carves a lower high. Buyers are still in control of price, but losing grip on momentum. On MACD, this often shows as a histogram that simply cannot exceed its prior peak, even as price does. Pair that with RSI rolling over from above 70, and you have a textbook setup. Hidden divergence is the continuation cousin. In an uptrend, price makes a higher low while the oscillator makes a lower low, signaling a healthy pullback before the trend resumes. In a downtrend, price makes a lower high while the oscillator makes a higher high. Hidden divergence is underused, but it is often more reliable than regular divergence because it trades with the trend. Here's a synthetic case. Price grinds to a new low on declining volume. RSI prints a clear higher low, and the MACD histogram shrinks visibly between the two troughs. Notice we wait for a bullish engulfing candle and an RSI cross back above 30 before acting. Divergence is a condition, not a trigger. The candle is the trigger. On real price action, watch how divergences cluster around structural levels. The cleanest signals appear where the oscillator divergence aligns with prior support, a trend line, or a Fibonacci retracement. When divergence appears in the middle of nowhere, statistically it fails far more often than when it forms at a level the market already respects. For entries, wait for the oscillator to cross back through its own threshold, 70 or 30 on RSI, or for the MACD histogram to flip sign. Place stops beyond the most recent price extreme that created the divergence. For exits, target the prior swing or use a trailing stop once price clears the structure. Take partials at 1-to-1 risk-reward. Divergence is leading rather than lagging. It often signals turns several bars before moving averages or breakouts confirm them. It works across timeframes and asset classes. And combined, RSI and MACD give you two independent measurements of momentum, so confluence between them dramatically raises the quality of any single signal. Divergence can persist for a long time in strong trends. A stock can print 3 or 4 bearish divergences while continuing to rally, never short purely because of divergence in a powerful uptrend. Also avoid divergences drawn across non-adjacent swings or across more than about 40 bars. The further apart the pivots, the weaker the signal. Layer divergence with tools that confirm exhaustion. ADX rolling over from above 30 suggests trend weakness. A test of the upper Bollinger Band that fails to close outside it pairs beautifully with bearish divergence. Volume drying up into a new high, visible on OBV, is another classic confirmation. Never trade divergence in isolation. Divergence compares price slope against momentum slope to spot exhaustion early. Use RSI for normalized context, MACD histogram for raw momentum, and demand confluence with structure. Tomorrow, scan your watch list on the daily time frame, mark every adjacent swing where price and oscillator disagree, and only act when a candle trigger appears at a known level. This is education, not financial advice. Trade your own plan. If this helped, do me a favor, hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.